In this video, I'm going to walk through calculating direct labor variances. And similar to what I did for a video with direct materials, I'm going to start out calculating our spending variance. And for that, I need our flexible budget, which we're going to call in this chapter standard cost allowed, but it's the same thing. And I'm doing this for our direct labor. So we're going to be a company that prepares in-flight meals, and I'm going to focus on one meal. And they tell us that during the most recent week, there's 4,000 actual meals. The quantity of direct labor we actually used was 960 direct labor hours. The total payment for our employees was $19,200, and if we divide that out, that would be $20 per hour. We also need the standard. We anticipated it would have required us 0.25 direct labor hours for each meal, and we anticipated we were going to pay $19.75 per hour. Again, let's start out with our flexible budget or standard cost allowed. Let's first start out with the standard number of hours we anticipated. 4,000 meals, the actual number of finished goods, times the standard of 0.25 direct labor hours means that we anticipated it was going to take us 1,000 hours to make those 4,000 meals. Now that I know it's 1,000 hours, let's get this standard cost times $19.75 is our anticipated wage rate per hour, would be a standard cost allowed or flexible budget amount of $19,750. Now that I know that, let's subtract that from the total actual cost of labor of $19,200 minus the standard cost allowed that we just calculated of $19,750. Our labor spending variance is $550 favorable. We spent less than we anticipated spending, so $550 favorable. That's nice to know, but similar to materials, let's break that down to be more useful between a quantity and price variance. However, like in many things in accounting, to make it a little bit more tricky, let's just change the language a little bit, but ultimately we're calculating the same thing. Instead of the labor price variance, we're going to call it the labor rate variance. And we're going to change the formula just a little bit. Ultimately, same thing, just changing the terminology. It's going to be actual hours, because instead of talking quantity with labor, we talk hours, times the difference between the actual rate and the standard rate that we paid for labor. Because, unlike material, for labor, we talk about labor rates, not labor prices. So let's jump in and pull this information for this problem. The total actual number of hours is going to be 960. Now, they went ahead and gave it to me. I worked through it. If they hadn't, if it was $19,200 total dollars divided by $20 per hour, it would have been 960 hours. But they did give me that information. Actual rate per hour was also given to us at $20 per hour. The only additional piece of information we need is the standard rate, also given as $19.75. So let's go ahead and solve this. 960 actual hours times the difference between $20 per hour, our actual rate, minus $19.75 per hour of our standard rate. So let's stop before we get the final calculation. Is this good or bad? We spent $20 per hour. We thought we were going to spend $19.75. This is bad or unfavorable. 25 cents more per hour times 960 hours is $240 unfavorable for a labor rate variance. Who's typically responsible for this? Oftentimes our HR department or personnel, possibly based upon, things like the experience level, seniority, was an anticipated raise that we paid the employees that we didn't necessarily anticipate when we created that $19.75 per hour. The other thing I want to calculate is our quantity variance. And again, we're going to call it something slightly different, and we're going to call it the labor efficiency variance instead of the quantity variance. Again, tweaking our material formula a little bit. standard rate times the difference between the actual hours and the standard hours. Again, good news, we already have most of this information. The standard rate is $19.75. The actual hours are 960. The only additional thing that we needed is what were the standard hours we thought we needed. I already worked through those in requirement 1. If you recall, 1,000 hours, 4,000 meals times 0.25 direct labor hours meant we thought we should have used 1,000 hours. So if we work this in, 960 hours minus 1,000 hours meant we saved 40 hours. Basically a work week for one employee. We saved 40 hours times $19.75. Again, let's think about this. Is this good or bad? Well, if we didn't use as many hours, this is going to be favorable. This is a good thing. Now, in the interest of, I want to show you the pattern of how to do this. I'm going to let you go ahead and multiply it out. So I'm not giving away all the solutions, but just want to stress that that's going to be favorable. Is who's typically responsible for this? Similar to our material quantity variance, who's typically responsible for a labor efficiency variance is usually production or operations, or supervisors, or overall plant manager, those types of things. In this scenario, it's favorable. So maybe perhaps we better trained our employees, we got better skilled employees. Those types of things could be responsible for either using more or less hours. Now, I didn't give you the total dollar amount, to work this out, but maybe these two are related. Maybe we ended up paying our employees more and it caused them to work more efficiently and save time. Or maybe the extra cost was getting more skilled employees, and again, they were more skilled, so they ended up not taking as much time. Ultimately, even though I don't have all the solutions listed for you, again, consider that these two are going to cross against each other. The $240 unfavorable rate variance plus the efficiency variance is favorable that you need to calculate will end up resulting in the 550 favorable spending variance. And again, I'm going to leave you to calculating the final number for the labor efficiency variance.